Hello, welcome to Fin225 International Finance Management, offered by Harper College. My name is Dr. George Mochocki. Today we'll be covering Chapter 12, Managing Economic Exposure and Transactional Exposure. So when we're looking at this, we're looking at hedging, and we're looking at economic, how to minimize our exchange rate. So when we're carrying a denomination of currencies for one of our subsidiaries, when do we bring it back to the parent company, and when do we leave it there? What's our strategy? So this chapter here is it's going to be a little shorter one. Hopefully, I'll get it done in a half an hour. We're going to be talking about a case. You're going to be working on a case in your teams. Going to be part of your final paper is going to be a multinational corporation. You're going to be setting up an operation in a country, and you can be utilizing some of these concepts. How you're going to be hedging? What are some of your exposures? What are some of your transactional exposures? So it's something we're going to talk about. So this case here, I'm just going to give you some examples, give you a little overview about the case, think you some areas to look at it, stop the video, look at it, answer it, go on, see what's the next step, and we'll work on that. Okay? So remember, this is a supplement. You read the book, you print out my mind maps. It's available in Blackboard Course Management System, or you're looking at this most likely in Harper iTunes Use, or sometimes some students will want me to post it on YouTube because it's easier for them to view on their smartphones, whatever. So sometimes I'll have it out there. But if you're not signed up for the class, we'll just give you a quick overview. You need the book because the material is more intense, gives you great examples in here. I'm just this one is at the end. You've read it, you've taken your notes, and you've been to the class. We discussed it. You did your homework, and now we're just a quick summarization. So all this makes sense. But if you haven't read the book, what's he talking about? How did he get to this point? You've already gotten to that point through the earlier discussions or reading of the material of the book. And remember, you could take this class at Harper College or at most of your community colleges. They'll have a similar course. If you're going to any kind of business, I don't care if you're going for associate or your bachelor's, you should have some classes in international business, international management, international HR, something with international. We're operating in a global environment. This gives you an edge over your product. It gives you an edge over someone else. Hopefully maybe give you a financial advantage because, hey, I have some international courses or exposure or experience to help you when you're either importing or exporting. And I understand that from the dollar side, the financial side. Okay, so let's see. Managing economic exposure. Again, we have different colors. This one's a little shorter. This is a case you're going to be working at in a team. I'm just going to give you a quick overview in case some of you forgot your books. A hedging exposure to fixed assets. Okay, so what do we have on here? So now if I'm looking, how do I manage it? Okay, now these are all ways that a multinational organization would be managing their exposure. Let me make this in here just a little bigger. Sorry. I apologize. 168. Let's go at least 200. Okay. Economic exposure represents the impact of exchange rate fluctuation on a firm's cash flow, in or out. Right? And then economic exposure, a lot of times we're looking at the exchange rate. Look at the currency. The currency is basically a supply or a product that has some value to it. And in which currency should I maintain, and which currency should I convert it? It depends. Which one has more risk, which one has a higher return on that investment. Bottom line is, how does the MMC, not the local subsidiary, should be doing well, but how does that component affect the MMC as a total? And here's your exhibit. Basically looking to the increase of its value. This is MMC. Management exposure improves its cash flows, reduces capital cost of capital. It means I have to buy something in currency, either pay it off or get a better deal. Because of currency exchange rates, I have an abnormal profit, one-time deal. So let's utilize this. Reduces its risk, stabilizes its earnings. Remember, you try to find that the MMC, as I've always been preaching, as the author's been preaching, is we're looking at relationships between different currencies, not to be rich. I'm looking at so my currency. I got my highs and lows. I'm working overtime and I'm not working overtime. Look at it this way: if I'm looking at cash flows coming in from your own, but you would rather have a stable across. I'm working like 3 hours overtime every week, so it's easier for me to to plan and to know how to pay my bills, and versus I got one way up here, and the rest of the time I'm just barely making it. So that's what you have to do when looking at inflows and exflows, cash flow. And one way is through the exchange rate, and another thing you have to look at the economic condition, not only the global that's going out there, but also the domestic that we're going. Remember, we're in chapter 12. We're going to start looking more from a corporation perspective. All right. So look at it. Okay, assessing economic exposure. An MMC must measure the exposure to each currency in terms of cash inflows and cash outflows. And again, you have the different exposures, the different things. U.S. sales, Canadian. So you have your, at different rates, exchange rate scenarios. So you know how much it is in millions, which is the best strategy at that time frame. Because remember, this is just only one component of what you're looking at to make the value, added value from a financial perspective from an MNC. Okay. Okay, now restructuring. Now, a lot of times restructuring is another way. If you, I'm looking at what's our topic. Remember when you had this printed out, managing economic exposure. So I may want to do some restructuring to manage it, increase sensitivity of revenues to exchange rate movements. Okay, when I'm restructuring, maybe I could do something like that, or decrease sensitivity to expenses. Either revenues coming in is very sensitive, or my expenses are sensitive because it's tied into exchange rate. Because the supplier is outside of the home country, for lack of better words. Okay, and here are your exhibits. So look at it. It's a lot of information. Look at the different exchange rate. The different scenarios, and then you could follow it through, and you see where you're at the bottom. And the same thing with 4, it's looking at your rate of exchange, the different scenarios for Canadian currency versus the dollar. Okay, proposed operating structure. So which one are we looking? What's my strategy on that? Okay, issues involved in restructuring decisions. Some issues you should be thinking about. And basically, by revising the input that reflected various possible restructuring, the analyst could determine how each operating structure would affect economic exposure. What the heck is it? What's the bottom line? If I restructure, will I be able to sustain the economic pressures that I'm experiencing now and within the next 3 or 4 years? And that's me guessing, taking an assumption what the government's going to do economically going forward. And I've been talking about the yuan, not the Chinese currency. It's devaluated again. There's a lot of stuff going on one way or the other. And, some people are hedging and weren't expecting that. And some have taken the hit. Some are losing. And some are smiling. Okay, expedient analysis with computer spreadsheets. It just shows you, and I think I got an exhibit in here. Well, basically, is determine the sensitivity of cash flows, ignoring tax effects, to alternatively exchange rate scenarios to be expedited by using computers to create spreadsheets. Spreadsheets are nice. You had the formulas, you feed in the information, and at the bottom line, once you understand the spreadsheet, you get your what they call the dashboard or at the bottom, and say, here's how much I'm making depending on the different scenarios, the exchange rate scenario, and which one would be the best one that would I be looking for. Okay? Yeah. Issues, remember, you can always blow this up. If you have it on here, just hit the plus and look at it, or look at it in a book if you're looking at your smartphone. Take your time, freeze it, look at it. Okay, issues involved in restructuring the decisions. Questions that you have to ask. Should a firm attempt to increase or reduce sales in a new existing foreign markets? And here's the exhibit on here. So I'm looking at recommended action when foreign currency has a great impact on cash inflows. And here's recommendation for outflows. Read it. Right, like I said, stop it right now. Take your time. I read fast. I talk fast. Read for comprehension. And second, should the firm increase or reduce its dependency on foreign suppliers? Something you're already looking. I'm looking at here. I'm managing economic conditions, and something's going on in that area that I might have to take care of. So do I reduce the dependency or do I increase it? Because now it's more of a benefit for whatever it was, the stability coming to that area. Should the firm establish or eliminate production facilities in foreign markets? Should the firm increase or reduce its level of debt denominations in foreign currencies? So it's something that I'm looking at, and all this has helped me to offset to manage my exposure. Okay. Now the next one here is going to be here, and I'm just going to be talking, just to give you a general idea, as I would in a class. For some of you who have missed it, you'll be working in your teams, and then the next team you'll be coming in and presenting your findings as different teams. So I'm looking at different teams, look at the same problem, and see if you come up with similar solutions or different strategies. That's what I'm trying to find out. Okay, so case and hedging. Before I do on that hedging, let me do a real quick reminder on hedging. So this is about like a 7-minute thing from Mr. Investopedia. Kind of like that, I got real quick little YouTube and things, 7 minutes, just to get your mindset in hedging, and then we'll talk about the different things that you have to look at the Savers Corporation's dilemma, what you're at, and how you would resolve it. Remember, you're looking at the Madison one is carries through the book, and the Blade cases that carries through the book. But this is just one specific, so you could take it as a team approach. And just here's what I have, and I'm just going to resolve this one issue. Remember, in finance, you have a lot of issues out there. You're trying to resolve the biggest issue that you think you can handle, or resolve some of the smaller issues that may become bigger problems down the road. Okay, so let's just click on this one here. Hang on a second.
Hedging is. What are Nadex binary options? Traders take a position on whether a market will finish above a specific target price. The resulting payoff? All or nothing. Why Nadex binary options? Benefit from fast market moves with short-term trading opportunities. Trade the most popular markets. Know your maximum risk reward before every trade. Stay protected from market spikes. Nadex is a CFTC
strategy that helps an investor reduce the risk he or she takes on an investment. Joe wants to invest in Sue's Gizmos, but he isn't sure if the company will succeed and return a profit on his investment. He purchases a put option, which acts as insurance and gives Joe the right, but not the obligation, to sell his stock in Sue's Gizmos at a predetermined specific price. If the price of the stock drops below this put option, Joe doesn't see a loss, because his stock is guaranteed to sell at that predetermined put option price. Think of hedging as being similar to your homeowners or auto insurance, which is purchased as protection against the loss of your home or vehicle. Although insurance money doesn't always cover all the losses you sustain, it prevents you from completely losing your investment. Hedging works the same way, and while it won't prevent an investment from losing money, it will help prevent a complete loss.
All right. Okay. Let me just close that one and close that. All right. Okay, so let's look about the Savers Corporation. Come on, it's real quick on hedging. It's just you're just putting money like insurance. I'm trying to find something that could make this creative instead of being dry. All right. So here's the dilemma. Here's some background information. Now this is strictly out of the book. I'll read it for you. Background: Savers Corporation is a U.S. firm primarily concerned with exposure to the euro. That's all they're doing. Now I'm doing. There's another video I've got in Blackboard on the UN. And that basically is the Chinese currency, the devaluation, and what's going on with that, with the market, that they think there's going to be some kind of other countries are going to devaluate their currencies to offset that. So you're having sort of like a reverse trade protectionism, that each one's trying to protect their own currency, and what's the backlash that's going to happen. Okay, Sever wants to pinpoint the source of that exposure so that they can determine how to hedge it. Remember, hedging is just put some money just to make sure something goes wrong. I got to pay something. It's my premium, my insurance. But how much is my premium? How much is my loss if it happens? Some OR has 3 units that conduct some business, so they have 3 separate units in Europe, different parts of the unit. They're using the euro, but it depends on the economic condition of the countries that you're looking at. Because each unit has a well-established variety of business arrangements, it is not obvious what all 3 units have a similar exposure. They most likely may not have a similar exposure, depending where each unit tends to be independent to others, and the managers of each unit are compensated according to their performance. So managers are always looking at their units, but does it help to the overall NMC, the parent MMC, the total value? Okay. Several may want to hedge its economic exposure, but must first determine whether it exposed. Whether it is exposed. Sorry, I typed that in wrong twice. Okay, let's erase that here. My error. Whether it is exposed and the source of exposure. General background. Okay, so assessment of economic exposure. You got to look at the relationship between the euro movement, the exchange rate of the euro movement against the dollar, and each year's cash flow over the next quarter. 9 quarters is all they're going to look at. That's more than enough historical, because afterwards you'll be in a different time frame. You look at the 9 quarters, give you more than enough. Remember, in the short term, it's easier to expose. Assessments of each unit's exposure. Okay. And then I've got this exhibit, so you can look at it, stop it, look at the exhibit if you have it, change in the unit's cash flows. Okay. Units A, B, C, D, different units cash flows. Okay, and then make sure you look at the change in total cash flows for the total MMC, multinational corporation, and then the change in the change in the value of the euro. This little hints in there. And remember, then you'll go back and you look at it, look at the chart, get your first impression, what you think, and then you go back into your teams, and then your team, you start discussing it. Now, here's some possible strategies to hedge economic exposure. And remember, there's no one correct way you're going to come up with. You're going to come up with why do you think this is the best strategy, or you may have a mixture. Remember, you could have a mixture if you want of this. Your pricing policy, hedging with forward contracts or futures, purchasing foreign supplies, financing foreign funds with which currency, revising operations of other units to offset or closing one down. Those are all things you're doing that we've talked about. Some of the restructuring. Remember, we looked at this. What you've learned on this one up in here. Let me just go in here real quickly. Remember what we've learned in here on this one, the different issues that we're looking at. Forget this. The restructuring, the assessing the exposure. Okay, which ones are we looking at? Did you have any kind of spreadsheet? And the spreadsheet could be just some information about a company or a similar industry. Remember that you could look up at that. There's different ways of looking at it. Okay. So you've got that. Now, here's Saver's hedging strategy. Instruct other units to do their financing in euros as well. That's just something so you're all playing with the same thing. Make sure that's what you're going to be doing. You may be wanting the strategy, but somebody on another team may say, no, we want to keep it in a dollar. I think that's a better option for us. Okay, limitation of silver hedging strategy. The impact of the euro movement on service cash outflow is known. Could be a limitation, which certainly, but impact of inflows is uncertain. So you're going to make some assumptions. What I'm looking for is what assumptions you made and why you made these assumptions. And here's where you're looking at. Give me something. Remember, we won't know until it actually happens. But what you're trying to do is give us, here's my logical rationale, how I would approach to minimizing any kind of fluctuation because of an economic exposure. All right. Okay, so hedging exposure to fixed assets. What do we have in here? Let me just close these off and I'll read it up to you. Okay, hedging the sales of fixed assets by selling the currencies forward in long-term forward contracts, futures, creating liability in that currency. Creating liability in that currency that matches the expected value of the assets in the future. Always looking in the future. We had some of that in finance. Always looking what's the future worth of the currency. You're taking a gamble with these factors. If it's stable, it's good. If it's not stable, then you got little issues if it's in a bullish market. Okay, limitations of hedging the sale of fixed assets. Basically, MMC may not know the date when it will sell the assets. So it's taking a guess. It's looking at, did I sell it too quickly or too late. MSC may not know the price and the local currency at which time they're ready to sell it, because in the future I could have some assumptions, but I'm taking again, I don't have that. I'm not a time traveler, or I don't have that crystal ball that actually works. Okay, managing transactional exposure. So if I'm looking at managing transactional exposure, let's just go transaction exposure, occurs when one subsidiary's financial data is translated to its home currency. It's converted back for consolidated financial statements. So it's coming back, and now I have to account for it in this current dollars or currency, whatever it is. They make money, they appreciate, they depreciate. So I'm finally getting back. It's worked well. All my managers doing good well in the subsidiary, but now the money is coming back. So now, unless I could list it, and like I said, what you read at the altar, you could list it in the annual report if there's something in here, if the numbers look skewed, and say, here's the reason, because of the conversion at this time we had to do in this quarter, denominations were brought into this currency, and that's why we had the loss or we had a gain. It's just basically on paper for that quarter, and it's still good. Okay. All right, so we have that. So hedging with forward contracts, what do we have there? Transactional exposure can be hedged with a forward or future contracts, using forward contracts to hedge a transaction exposure. I'm just doing something in advance. I'm doing a forward contract, locking in a time price. Here's what I'm expecting it. I'm paying my my premiums, but it's like insurance, like they mentioned before. Insurance, I'm paying for it to use it, but is it offset? I may not lose all of it, or it offsets some of it one way or the other. Okay. Okay, limitation to hedging transactional exposure is okay. So I have inaccurate earning forecasting is one. Earning a future period uncertain, we're not sure. Inadequate contract for some currency. Forward contracts are not available for all currencies, depending on the currencies I'm utilizing. Where I'm with currency acceptable that makes sense for that transaction at that time because of the subsidiary's location. Accounting distortions, the forward gain or loss reflects the difference between the forward rate and the future spot rate, whereas a transaction gain or loss is caused by the change in exchange rate over the period in which the earnings are generated. Jeez, I wish I had a prop in that, okay? So when I'm looking at it, is it the forward rate or gain? Okay, the spot rate is exchange rate over the period. Exchange rate, gain or loss. Did I make the money on this when I cashed it in with my forward rate at that time when I had the contract, or did I lose money? And I'm taking a gamble. But a lot of times you're going to find out people who have been doing this for a while, they're pretty close. Yeah, there's once in a while they're off, but most of the time they're on there. It's the new ones who are coming in or have a new system, or trying something else, or because the market changes and now you have to use a different strategy and you're not that comfortable with it. So remember, start off with small steps to see what happens before you take those larger leaps. Okay, increasing transaction exposure is MSC be increasing their transaction exposure. That can make sense when I'm doing anything with exchange rates. There's no way around it. When I'm bringing that. Okay, let's look at summary. In summary, I only have a few call-outs. Economic exposure, this was a short chapter, can be managed by balancing the sensitivity of revenues expressed to the exchange rate fluctuation. I can manage it. When I say manage it, and I'm looking at my brother's a diabetic, so he's managing his sugar intake. But he has to look. He eats something else. He's always adjusting, and that's what you have to do when you're a financial manager. How do you manage economic condition? You're looking at it. You're making small adjustments. That's what the Fed's doing. Making small. You should be making small adjustments, not the big drastic ones. And then, okay, it doesn't go just right, but I didn't make that big. I'm hedging just a little bit, just to be on the cautious side. Okay, and how do they accomplish this? The firm must first realize how its revenues and expenses are affected by the exchange rate. What effect does it have? The software tells me the exchange rate goes up. Here's what's happening. I got an inflow of cash is down, or I have too much cash. I got to get rid of the cash, and now I'm getting rid of it. I'm not making the money on the cash because it's because exchange rate is not favorable for me. Okay, for some firms, the revenue is more susceptible. Okay, these firms are more. These firms are most concerned that their home currencies will appreciate against the foreign currency. My currency to be worth more than the foreign currency. I don't got the foreign currency to hedge. I don't want it to be worth more. My currency is worth more. I would rather have it worth less, depending on the strategy I'm using. Since unfavorable effects on the revenue will more than offset favorable effects on the expenses. Okay? Now, controversially, firms whose expenses are more sensitive to exchange rates than their revenue are most concerned that their home currency will depreciate in reverse. The other one was depreciate against foreign currency. When firms reduce their economic exposure, not only these unfavorable effects, but also the favorable effects of the home currency moves values in the opposite direction. When I'm looking at a global, something happens here that affects let's say the supply of a certain currency, takes it out. It's going to affect the supply in the whole system. Something puts it in, it's going to affect the supply level in that. So I'm doing something here to stabilize this home currency, but in effect, I globally may have also some positive, which may be a negative, depending on my strategy that I'm trying to do with the currency, bring it back in, which is stronger. Remember, like we talked, is the currency appreciating or is the currency depreciating against my currency, my home currency? Okay? Let's take care of economic. Now let's look at the transactional exposure. This one's not too bad, just one call out. About selling forward currencies or future currency contracts used to measure the subsidiary's income. The foreign currency depreciates against the home currency. The adverse impact on the consolidated income can be offset by the gain in a forward sale in that currency. If the currency appreciates over time, there will be a loss on the forward sale effect on the report of the consolidated earning. You're going to lose in this case. However, many MMCs would not be satisfied with paper gain that offsets the cash loss. Yeah, it's just paper, so there's not really anything happened. I couldn't see a difference. I ate so much and I threw up so much. What happened? Okay, I'm stable, but I did want to see a little bit of gain going forward. I did something better and at least made some money. Remember, I'm always trying to make some money with the money. Not so it sits there, then I might as well just bury it. Alright? Okay, so that took care of our call-outs. We basically, on this chapter, this economic exposure, transactional exposure, looking at the exchange rate. We did a whole bunch of, we had a case that you'll be working on. We'll discuss it in the classroom. You have different charts to look at it. Stop, take a look at it. Remember, if you're taking this, just found this on YouTube, make sure you sign up for the class at Harper College. It's Fin225. You can either take me an online class or face-to-face class. There's another instructor that teaches the same course. He may have or she may have some information on Harper iTunes News and see which one makes sense. You know, a lot of times we may just have a 5-minute clip on how to do something, or in this case, I'd like utilizing somebody else's clips because they already got the animation. It makes it real simple. Investopedia, I like them. They got real short to the point. You understand the concept. It's easier to understand what's going on internationally. Once I understand what's hedging, what am I doing? Now I just have to understand as going forward, understanding the countries or in the operation I'm actually looking, not the global, but what's actually going at that currency and with that my industry or my subsidiary there, and how could I maximize that cash. Remember, if I do well here, hopefully it'll be, as long as I'm always doing positive, it's going to do well for the value of the multinational organization. Again, my name is Dr. George Mochocki, and this is Finance 225, Chapter 12, Managing Economic Exposure and Translation Exposure, offered by Harper College, face-to-face class or online. This is just a overview of what you've read, you've discussed in the forums or in our lecture. I'll see you in Chapter 13 coming up soon. Bye.